Hello everyone, welcome back to Financial News. Today being February 18, 2020, Paul is going to give us a recap of what took place in the marketplace and any financial news, Paul?
Definitely. We've been reporting a lot about the coronavirus and how it's affecting the markets, and we're going to continue to do some today because that is the story. And today we're going to talk about recession risk amid the coronavirus outbreak. So let's get into it. Over the last decade, the pace of economic expansion in many developed regions of the globe has been well below that of historical averages. Though frustrating in the early years, especially for those seeking employment, such conditions are also very likely supporting the current economic expansion's longevity in our view. There simply has not been the typical buildup of economic imbalances, most notably consumer debt, that so often leads to downturns. Though we've viewed the slower rates as more sustainable, think more of like a marathon runner versus a sprinter, the lower rates leave less downside for GDP numbers and possibly slip into negative territory. Such is the consideration today in many regions of the world as forecasters consider the very uncertain impact the coronavirus on near-term economic activity. Actions taken to stem the virus's spread are clearly constraining economic output, mostly in China, but by relation in other sectors and countries around the world. As such, the odds of some countries slipping into a technical recession have increased significantly. For instance, Japan reported a sharp decline in Q4 real GDP, largely due to the scheduled implementation of an increase in its national sales tax. Due to the coronavirus outbreak, the country is increasingly likely to post a decline for the current quarter as well. Note, at this point in time, though, we do not expect the U.S. to post a negative quarterly GDP print. How should investors react to this kind of news? We believe current conditions are much different than that of a traditional recession, and we believe markets have been reflecting as such. We believe it's correct to expect economic activity to rebound as the outbreak subsides, especially in the hardest hit areas. Lost economic activity as well as corporate sales and earnings lost are unlikely to be fully recovered, but we still believe this situation to prove temporary, although obviously very material. So in essence, due to the coronavirus, spending is slowing, mainly in China, and that may spread to all over the world. But once we get this coronavirus in check, and hopefully we do sooner rather than later, things should return back to normal.
Okay, Paul is with Ameriprise Financial, and Ameriprise Financial had also supplied us with the morning news, and it is as follows. After closing at a record high on Friday, S&P 500 futures are lower this morning. After Apple warned fiscal Q2 revenue will come in below prior guidance. And the yield, and is there anything you want to add to that?
I mean, Apple's just such a big global company. That's big news. You want to see what Apple is doing. Some of this could be from China-related coronavirus issues, but there's some things going on there.
The yield on the 10-year Treasury fell into a near 1.54% as concerns over the spreading coronavirus also persist.
And you'll see investors move to safe haven bonds if they're worried about what's going to happen in the market. That's normal.
Yeah. And global oil prices are under pressure after commodity posted its first weekly gain since early January. But that's been up and down this last few weeks.
All markets don't go in one direction permanently, so that's a normal.
Yeah, it's a normal as well. And I'm going to give you the S&P 500. The year-to-date is 4.87, a plus. The Dow Jones is a plus 3.36% year-to-date, and the NASDAQ Composite is a plus 8.63% year-to-date. Anything else you want to add to this, Paul?
Those are just good numbers. I mean, everyone knows we're halfway through February here, but a few years ago, those would be good numbers for the year.
For the year.
We're getting them
And
2 months
Here
in.
we are, 2 months, exactly. It's just solid. It just is so solid. Okay, well, we're going to be going to our other show called Your Money. Paul is going to be talking about 5 money myths to ignore. Stay with us. We'll be right back. We'll be talking about them. And we're back with Your Money. As I mentioned, Paul Munico from Ameriprise Financial is going to be talking about 5 money myths to ignore. And Paul, I'm going to let you get started because I have some bullet points that you've supplied me that will help with your presentation.
Okay, great. You know, when it comes to personal finance, what works for one person doesn't necessarily work for another. That's why money misconceptions, they can be so dangerous. So today we're going to go over, like Ron said, a few of the common money myths that you may have heard and perhaps even believe that maybe it's time to put those to rest. So why don't you start us out, Ron?
No, and the first one, the most important is all debt bad?
Is all debt bad, right? Or all debt is bad, sorry. That's the quote. Reality to that is few people could afford to buy a home if they didn't have a mortgage. You may not have gone to college without taking out a student loan. Instead of avoiding all debt, make sure you have a plan to pay it off by addressing high interest loans first. So taking on debt is not a big deal as long as you have a way to pay it off, and it's very common to take on debt.
And what about avoid all credit cards?
This kind of goes along the lines with debt. So in reality, credit cards offer flexibility that cash and debit cards don't. Most card companies offer zero liability for any fraudulent transactions, while most debit cards have little protections if you find the fraud after a certain date. Plus, you can earn extras through your credit card rewards, like airline miles for your future travel plans. Instead of nixing credit cards altogether, plan to pay back the balance in full each month, avoiding the high interest charges.
And you can time the market, can you not?
That's the one I get the most. Yeah, it's very, very difficult, if not impossible, to time the market. So the reality to that one is there are many factors that influence the day-to-day stock moves. The unpredictable news cycle, the economy, business decisions, rates, and regulations are just to name a few of the variables. This is why timing the market is so challenging, even for professional traders. While someone might get it right once, in order to end up ahead, studies have found that one would need to guess correctly more than 65% of the time. If only a handful of professional investors manage outperformance each year, the average investor's chances are pretty slim. Meanwhile, you lose out on gains if your money sits on the sidelines while you seek the perfect moment to play. Stock markets are notoriously unpredictable in the short term, and they should not drive investment strategy for most investors.
Paul, what about pay off your debt before saving for retirement?
That's a good myth. The reality to that one is the interest on your student loans, for example, may be 3.5%, but expected returns in the market might be 5%. Then consider adding funds to your retirement account since you're making more than the loan costs. You could lose out on opportunities like the benefits of compounded interest if you're only focused on debt repayment.
And most of all, we talk about at every one of our sessions, we talk about you don't need a financial advisor. That is really the wrong thing to approach.
That's definitely a myth, in my opinion. And the reality behind that is, many believe that a financial advisor's only job is to beat the market. To believe that would be to miss the main point of why it's helpful to have a professional help you with your money. At its core, a financial advisor's job is to keep you on track towards your financial goals, whether it's retirement planning, savings for college, or meeting any other goals. An advisor can help you determine how to approach some of life's biggest financial decisions, Having a trusted advisor, you can feel more confident in your financial future.
Very, very true. And we always talk about financial advisor, and, as I had mentioned at all our shows, it is so important that you're not assuming things and then presumably you make decisions and they're wrong and you try to figure out why you did that.
Yep. An advisor is there more to just pick good investments for you. There's a lot more with the advisor-client relationship beyond that.
And of course, it includes someone taking a look at the overall on your portfolio.
Exactly.
All right, thanks, Paul, for coming in for the viewers and sharing this with them. Is there anything that you would like to share with them if they had any questions about our session today?
Just dealing with these myths, and especially point number 5 about working with a financial advisor. If you're not working with one, or if you're considering changing one, please give me a chance, and you can call me directly with questions or concerns at 708-226-3412.
All right, thanks again, Paul. For Paul Munichel with Ameriprise Financial, myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you good investment day.